Welcome everyone to our construction loan broadcast. I want to thank you again. I know time's a little bit crazy right now, but thank you for taking the time to join us. I'm Omar Abich with Simple Mortgage. Wanted to introduce Jonathan Brandeo, who's a senior relationships manager with AFR. They're based out of New Jersey, and they're the specialists in construction loans. So thank you, Jonathan, for joining us.
Of course. Thank you so much, Omar, for inviting me today, and it's my pleasure to jump on and go over the details of the program with you.
Sounds good. And I also want to remind everybody there is a questions section on your webinar. Feel free to ask questions. I'll try to get the questions. I'm trying to interrupt Jonathan Brandale too much, but I'm going to try to ask some questions. And of course, you guys could ask some questions and I'll make sure that they get answered. And I hope it's okay, Jonathan, we interrupt you at times to ask these questions.
Of course. Definitely. Yeah, I have a presentation that I'm going to show you guys, just give you kind of the high level overview, give you some bullet points of the process flow for our one-time closed construction to perm program. But of course, if you do have any questions while we're making our way through the presentation, I'm more than happy to answer those.
Awesome, sounds good. But we're excited to see what this is all about. And again, whoever's on this call, on this webinar that doesn't understand, make sure that you talk to one of us, the loan officers, so we could explain it, and we'll go talk to AFR. But I understand not everyone's going to understand everything, so we'll make sure we clarify after.
Awesome. All right. So yeah, so we'll jump from there. Oh, thank you so much. So yeah, once again, just to introduce myself, my name is Jonathan Brandeo. I'm here at AFR, American Financial Resources. We're a national lender who we do offer our one-time close construction to perm program. Now, we do offer that program for many different types of options, different types of borrowers. And what we're going to do today, and it was great that Omar invited us to join and present to you guys and show you exactly what we have to offer with that program and see what works as kind of the best. So you always have these different kind of ideas and tools in your pocket to really help you have something out there in the market in case you ever do come across somebody who's looking to do a construction loan, but not just a construction loan, but also doing their permanent financing rolled into one. So that way you don't have those two separate types of transactions. So we'll go over some highlights. We'll go over some bullet points. Like Omar said, if you do have any questions, feel free to jot those down. I'm happy to answer them as we're making our way through. So thank you for joining. We'll jump right into it. So just to kind of use the visual that I have here, I have a little bit of a presentation. So first thing, a little bit of highlights of the program itself. Now, for the program, we have a couple things. And the great thing about it is that AFR actually does the majority of the work completely in-house. So here in our headquarters in New Jersey, we do have a dedicated team that specifically just works on this program. And the great thing by having a team that's dedicated just to that program, it allows us to have a better service when it comes to that program. It allows us to have faster turn times for reviews. Faster responses, more concise and direct responses for any questions that anyone who's involved with that loan may have when it comes to the process, whether it be the brokers that we're working with or may it be the builders that we're working with from there. Some highlights that we have on our program here. We have calculations, and we'll talk about that a little bit. We have our one-time close calculations. Those can be done in less than 48 hours because we're doing that in-house. You're clear to close. Once your loan has been clear to close and everything's been cleared, all your borrower conditions and your builder conditions have been cleared, you can clear and get that clear to close and be at the closing table within 3 business days. On some other construction programs that are out there kind of in the world, those may take significantly longer to close once you get a clear to close because there's a lot of behind the scenes that goes with the creation of those closing packages. By us having that in-house, it allows us to go forward and make sure that's all kind of set up the way that it needs to be. The great thing is that our AFR OTC team can speak directly to both our client partners and the builder or retailer, which allows for that faster turn times, a streamlined communication, cleaner purchase contracts because we're being very clear and concise on what we need those to read as and what information is needed on those cases, and less pitfalls because you're coming to just us. You're not going to a third party. those partners that we're working with are coming directly to AFR. We do, like I was talking about with those calculations, have a single construction fee, which includes all your construction-related costs into that one fee. For your government options, for example, you can roll in and finance that fee into the loan itself. That way, the borrower and the builder are not paying that fee out of pocket. It covers all the fees that are required to be covered during construction, but without the borrower having to pay that money out of pocket, it'll be financed into the loan itself. The credit and construction conditions are all done by our in-house team. Both conditions for both the borrower and for the builder will be cleared by our team. We both have a credit underwriter who does all the borrower conditions and the construction underwriter who does all the builder or retailer specific documentation. Because that's all done completely by AFR team members, once again, it speeds up that process. There's no need for a second submission to a third party. It only requires you to upload to one section. And once again, you're only communicating directly with AFR without having to go through multiple parties to try to get that transaction. And a wonderful thing here as well, not only for our broker partners, but also for our realtor partners, your commission would be paid at closing. And the wonderful thing is closing happens before the construction even starts. So that loan will fund and close before anything has been done to the property in question. So that's the biggest thing. So everybody who's involved will receive their commission at the time of closing before, no matter how long construction is, because it happens before construction, you're going to get your commission right there prior to construction starting. So those are some highlights. Now kind of jumping a little bit more into some more specifics, just so you have more visuals. We'll go into kind of an overview of what the program is and kind of what to kind of get your brain moving from there. So just a little bit of overview. So a one-time close program provides interim construction and lot purchase, if the lot is being purchased, and a permanent loan all wrapped into one. So whether they own the land already, whether they have a lien on it, they own it free and clear, or they're looking to purchase a piece of land that they don't currently own, that can all be rolled into that one loan with the one-time close program. Because that loan is closed before the construction even starts, there is no requalifying of the borrower when the loan modifies to a permanent loan. So once you get to that period where construction has been completed, the home has been fully turnkey completed, and the loan is ready to go ahead and modify to a permanent loan, we wouldn't require the borrower to requalify. So that way, everybody who's part of that transaction is safe. And once again, the builder is going to get all the money that they're expecting to make at the end of the day, because as long as they build that home 100%, they finish it, they're guaranteed to get their funds, borrower's guaranteed to get their loan, and everything's already have been set in stone prior to even construction starting. And once again, because of that, no need for reappraising, no need for second closings, and there's no additional closing costs because everything was set in stone prior to construction starting.
Great.
Some features.
So
yeah, wonderful. Yeah, no, it's a wonderful program. It's the thing is about the program a little bit is that, and you can see from some of these things, is that the program itself is very involved. There's a lot of kind of pieces and moving parts and a lot of different parties involved in the sense of having your broker partners, you have your borrowers, you have your builder, you have us, of course, you have AFR, all from there. But it is a wonderful program that when you really kind of get the bits and pieces of it, it's wonderful to have in your back pocket. So because for people who looking, especially nowadays, people are looking for different types of options when it comes to whether an existing home or whether they want to just build the home that they're looking to always want to build. They have different options from there. This page kind of goes a little bit more into some things that I've already brought up about everything is locked in prior to closing. Same thing with the rate. Your rate that you choose on that loan will be locked in at the time of closing. So the same rate that we closed on will be the same thing that the permanent loan is going to be, no matter how long the construction takes. And especially with things kind of fluctuating all over the place nowadays, that's a great thing because who knows what it could be 12 months from now in those cases. So that's protected in those cases. Like I stated earlier, if you go with our government options, so FHA, VA, and USDA, you can roll those construction-related costs into the financing of the loan. That way, the borrower is not making any payments during construction. Everything's already been financed in, so they do not make any payments until the home has been 100% completed. Everything's done to modification, and then they start making their mortgage payments. So it could be 12 months before they start making their mortgage payment, and that's perfectly fine because they don't need to make it until the home has been completely done. The only time that it's different is on our conventional options. So the Fannie Mae and Freddie Mac options, the borrower does need to be required to make interest-only payments for each of the months that construction is taking place on. So let's say there is a 10-month construction period. For each of those 10 months, the borrower would be making interest-only payments under the conventional option. So in those cases. Otherwise, for the government ones, you could roll it all into the actual loan itself. But yeah,
I had a question for you, Jonathan.
Yeah, go ahead.
So in regards to, like you said, conventional, so I understand that you don't make any payments for the Govy stuff and USDA, but for conventional, you pay interest only. So you said something about like the cost, like let's say the blueprint costs, basically to get the plans approved. Let's just say school fees and stuff like that. Let's say it's 30 grand. Is that something that can be rolled into the government ones, but not the conventional? Did I understand that right?
No, so any fee, any builder or retailer related fees can be rolled into the loan. So it would be the builder or the retailer's responsibility to include all those costs into their contract. So they would include that in their full contract price. That way it can be rolled into the loan.
Makes sense. And just to clarify, this does not, because I think I asked Laura from your company about accessory dwelling units. It's pretty big over here in California. I think she told me it does not apply to accessory dwelling units, correct?
Correct. Yeah. So for our programs across the board, whether it be construction or renovation, we don't allow for the building of accessory dwelling units.
All right. At least as of now, for now.
Yeah, currently, but yeah, we actually just recently announced that we wouldn't be allowing those. But if anything changes in the future, then we'll always post an update if anything changes later on in the future.
Got it. Thank you.
No problem. All right. So yeah. So once again, it just says in here, everything's 100% in place prior to construction. So kind of going off of what we were actually just talking about. So what type of construction is allowed for this program? Now, the easiest way to remember, if you always have a question, if you come across, there's a lot of different types of builds that people do across the country. There's a lot of strange ones that come across, a lot of unique ones that are different. The easiest way to remember of what we will allow for, at least for AFR's program, is we just allow for your traditional kind of straightforward construction. We allow for manufactured homes, modular homes, for your traditional kind of site or stick-built homes. Those would be the types of constructions that we can do. The type of construction that we won't allow for, we can't do single-wide manufactured homes. We wouldn't be able to do condominium projects, multi-units, multiple homes on one piece of land. No attached housing or semi-detached, no ADUs in those cases, and your unique or niche type of homes we wouldn't allow. So your log homes, barn dominiums, metal homes, tiny homes. I've even seen like straw homes in those different cases. Unfortunately, at this time, we wouldn't allow for those specialty types of construction. So as long as it's kind of your straightforward single-family home, modular, or manufactured home, multi-width manufactured home, then that'd be something that would fit perfectly into our particular program in that case.
Okay, so no multi-units. So we're not talking about commercial over 5 units. We're talking about even two to four. You're not doing 2 to 4 units either.
No, so for our program across all the agencies, our maximum number of units is 1.
Got it. And is it a matter if it's owner occupied or non-owner occupied?
It would be, so for the construction program, it would be primary and second homes only. No investment properties.
Got it. Got it.
Yeah, and second home would only be available for conventional. For the government, it would be primary home only.
Got it. Makes sense.
Yeah, and that's actually where I'll bring up here. This is actually a little bit of a visual to go along with what I just answered. So yes, this kind of goes into the specifics of what's allowed depending on which particular agency you're looking to use in those cases. Across the board, one of the things too I always like to bring up is that we don't offer for jumbo construction loans. We're maxed at your max conforming loan limits. The only option that does kind of go into your jumbo ranges would be VA. VA does allow you to go up to 1.5 million. You can see on here that VA, anything above 765,600 would require the borrower to bring 25% of the difference if you're going to go up to that 1.5 million in that case. For all of our other agencies, we would be maxed on our program into your conforming loan limits for your counties in those cases. They do, for all the government options, we do have a 620 minimum credit score requirement, and we do require an approve eligible or an accept across the board for all of our programs. So across the board, no manual underwrites for this particular program, no matter which agency you're looking to use. They can go ahead and get their traditional gifts. You would follow your traditional guidelines for the different agencies that you're using if the borrower is looking to get a gift. So if they're getting it from a family member or so forth, you actually could use that towards your transaction as well. You could see as we're getting down into the conventional options, the Fannie Mae option is actually an option that we just recently rolled out last week. Actually, last Friday was the first day for the Fannie Mae option. The Freddie Mac option we've offered for about a year and a half now. With the Fannie Mae option is brand new as of last week. The differences between there, they follow the exact same guidelines. The biggest difference being what your FICO score requirements are. Fannie Mae, you can go down to a 680 if you're doing up to an 80 LTV. If you want to go up to a 90 LTV, you can get a 700 score minimum on Fannie Mae. For Freddie Mac, they require a higher credit score requirement when it comes to those different LTVs. So it'd be 700 for 80 LTV for Freddie Mac and a 720 minimum for a 90 LTV on your Freddie Mac option. Otherwise, they do have the same exact guidelines when it comes to those. Differences, of course, too. We do still need that approve eligible or accept. Fannie Mae would be through DU. Whereas the Freddie Mac, of course, would be through your LP, your loan prospector in those cases. Big thing, too, the difference between conventional and government is that on conventional, there is a 10-month build limit. You can't go longer than 10 months on the build for the conventional options. For the government, you can go up to 12. So you get an extra 2 months on government, whereas the conventional options would be 10 months would be the highest that we could go for the build time.
Question for you.
Yeah.
So someone's asking a question in regards to, well, number one is the time, the build times, right? Because I mean, if you can buy a lot, just to get approved to build a brand new house can take up to a year, over here, realistically. And then building doesn't take more than 6 months in the best case, in a normal scenario. So that's something of concern when you say 10 months. I mean, is that 10 months including the time to get the property approved for build to start building? Or is it just strictly building portion?
It would be 10 months from the time that we close. So once we close, then construction can start, and it'd be 10 months from the day we close. It'd be 10 months would be the max for conventional.
Right. So let's say a client wants to buy a lot for $100,000. The build is $500,000. He purchases. I mean, he's buying the lot on this transaction, right? Is that what you're saying?
Mm-hmm. Correct.
And then he's gonna go apply. You got to go apply to get the approval process. So that approval process could take up to a year. So he can't start building. So I guess my question is, how does that work?
So in those cases, we would require that to be done prior to that loan coming to us. If it's going to take that long.
So most likely it's going to be that makes sense. Because realistically, this is more.
Yeah, because this program would fit better. This program would fit better for somebody who's ready to build at the moment we close. That
owns a lot already, probably, and already has plans approved or close to being approved. That would make sense. And then someone had a question. Most builders overcharge as they want to build contingency cushions. What happens when they estimate 600,000 for the full project, but the project only uses 550 or less? How is the loan structured at that point, or what happens to the additional monies?
So what would happen is that one of the biggest pieces of our one-time close program is what we call the one-time close calculation results. And what that's going to do is that we would require at the time of when you register that brand new loan with us, we're going to require you to provide us with the basic numbers of that transaction. So they would let you know, we would need to know like what the builder's net price is. So what they're expecting to make as a profit at the end of the day when the build is completed. So let's say they say their full build is 600,000. They're saying is going to be their profit at the end of the day. So you let us know that that's the amount. Our one-time close team is going to return to you with a result sheet letting you know what our construction administration fee is going to be. So that fee is going to cover all those construction-related costs. The builder would then be required to add that construction administration fee to their contract, increasing the purchase price to cover that, which also allows that fee to be included, financed into the loan itself. Now, what's going to happen is that because we close prior to construction starting, for this particular program, the best way to do it, and really kind of the only way to do it, is that we would require all those numbers to be set in stone prior to closing, because once we close, nothing can change. So fees cannot go up and fees cannot go down. So if for some reason, if they do say, let's say it's $600,000, that's what we close on. If they get to the build, everything's 100% done, and they only used 500,000 of it. That extra 100,000 goes directly to the builder. It doesn't go to anybody else. It goes directly to the builder because that money was allotted to them at the time of when we close. So if some kind of conversation wants to have between the builder and the borrower outside of our transaction about that money, that would be between the builder and the borrower. But we're going to give the builder directly the money that was allotted to them at the time we closed, not anything more or anything less than that.
Yeah, that makes sense. And then what if when you do the appraisal, let's say you guys do the appraisal, and the appraisal comes in higher than what was needed? I mean, someone's asking that question, but basically more than what is needed to build the property. Does that change anything?
No. So the only thing that would change things is if it came in less. Then things would need to be renegotiated to figure out specifically if numbers need to change in order to cover anything coming under appraised. Because the appraisal has to have a number that's either equal to or higher than what the full cost of building that land and including our administration fee that we're giving you.
Makes sense. And then lastly, that 10 months is a hard rule. There's no like 1 month here or no exceptions for the conventional 10-month build rule?
If they go over the 10 months, the builder will start losing out of their profit for each month they go over. We'll start taking the money out of their profit.
That's good. Yeah. Is there a specific form they need to? I figure there's a form that says that they need to sign.
Correct. Yeah.
They're going to be penalized, right?
Yeah. When they get approved with us, so one of the first steps of the process, and you can kind of see from here, is that one of the first steps is getting that builder or retailer registered with us. They would be required to fill out a registration packet, which has a 6-page agreement that goes through the specifics of what their responsibilities are as a builder or retailer and what the penalties would be if they do certain things that are outside of what the program allows.
Makes sense. Thank you.
Yeah, no problem. So actually speaking about the builder, as we're talking about that, so that builder or retailer, so builder, of course, being your kind of straightforward site-built type of home, and retailer being your manufactured or modular homes, that builder or retailer must act and be the general contractor on that transaction. They'll be the ones responsible for the full turnkey completion of the home and all the required site improvements. Now, they can hire as many subcontractors as they need to do that work, but the way that our program works is that we require just one general contractor and one company that we're going to be working with directly, where all those funds and information is going to be funneled through that one specific company. So whenever they're paid through their draws, that money is going to go directly to the general contractor, and then that general contractor would be responsible for paying all the subcontractors that they hired for the work that was needed for that particular build. Another thing with that as well is we do not allow the borrower to do any type of work at all on the property. The borrower cannot do any of the construction. They can't do any of the site improvements, nor can the borrower have any say in the hiring of the subcontractors to perform those work. All the subcontractors have to be hired by that general contractor. They cannot be hired by the borrower. And then, of course, the borrower cannot be related to, be in an employee-employer relationship, or have any type of identity of interest between that builder and themselves. So it has to be a complete 100% arm's length transaction between the borrower and the builder. We do get questions all the time of a builder who wants to build their own home, or their father owns a building company. Unfortunately, for our particular program, that's not something that would be allowed. It has to be a complete arm's length transaction where the builder and borrower have absolutely no relationship between the two of them. From there, kind of talking more on some other things we went over, we talked about the land. The land can be a couple different ways. I'll just quickly go over this since we touched on it a little bit. Land can be purchased as part of our deal. It can be gifted. They can already own the land, whether they own it free and clear, they just recently purchased it, they have a lien on it, they might have equity in that land. Now, equity, you can actually use land equity towards down payment. However, it's only available on the government options. The conventional option, unfortunately, it's not really an AFR rule. It's more of an agency rule when we set up the program with Fannie and Freddie. Unfortunately, you can't use land equity towards down payment when it comes to the conventional options. FHA and VA would be the only options that you can use land equity. But if they do have it, you could use that towards a down payment in those different cases. You can get your normal seller concessions based on agency guidelines, 6% for FHA and USDA, 3% for conventional, and 4% for VA, as long as you follow all your VA normal guidelines when it comes to your allowable fees that you can do for a VA transaction. So let's talk about the draws. So here's the different ways that we can set up the draws of how the builder is actually going to be paid. Now, the biggest thing to remember, especially if you're going to go out and speak to any builders about this program, is they do not receive any funds at the time of closing. The way that our draws work is we provide funds on a reimbursement schedule. So the builder would be responsible for upfronting the funds in order to get that project started and continue moving that project forward. What will happen is that when the builder has built a certain percentage, let's say they've done 10% of the work, they can request a draw, and then our team would send out an inspector to confirm that that work was completed. Once we've confirmed that that work is completed, we will provide them with 10% of the money that was escrowed based on the amount that we closed on in those cases. And we will do that up to 5 times. So you have 5 draws as the maximum. They can choose to use all 5 draws, or they can go ahead and just use whatever combination of those draws work the best for that particular builder. But that's the biggest piece. And I know we've talked to a lot of builders over the years. Some builders are very comfortable with that, and some builders don't have the line of credit or the different information there to be able to provide that stuff. But that's a big piece if you're ever speaking to your builders about the program. Now, that's the traditional draw program, which you'll see there on the left side of this page. But we also have another option called the no draw. Now, the no draw is available for your kind of manufactured or your modular homes. Now, it can be used for a site-built home. Right now, the no draw option is only available for government, but in the future, we are working on getting that available for conventional. And what that's going to be is that the builder gets no money at initial, like always, and they get no funds throughout the entire construction. Once the construction is 100% completed, then they will get their funds. So they'll get those funds at the time of once the home has been 100% completed. We confirmed that the work was done in those cases. The reason why somebody would use that is because it does make our construction administration fee less. It makes it a lot smaller, and there's a lot less fees kind of being rolled into that loan, And there's no third parties involved for having to do multiple inspections, having to do draw requests through different companies, having to do all those different things. It's all just kind of streamlined from there. The difference on no draw, the maximum amount of build time on that is 5 months. So that's why it works better for your manufactured or modular builders, because those homes are being built in a factory. So a lot of times, sometimes they're already sitting on the lot and they're just ready to move and they just have to be placed on a piece of land, or those cases. So the no draw option, we usually always see it being used under your manufactured and modular because they can kind of turn those around a lot quicker. But you can do it on site built if you have a builder who could build something in less than 5 months and has the capital to upfront all the funds themselves and then just get paid at the end once everything's 100% ready to go and completed.
Question for you, Jonathan, just really quick. In regards to the draw, you said maximum 5 draws. Are you charging per, like, or do you guys have fees that you're adding in there for each draw? Like for inspection to go out there and physically see the property?
Yeah, so that's actually the next section that we're jumping to here. So those draw fees and inspection fees and everything would be rolled into our flat administration fee. So so we have that flat administration fee, which would be calculated right at the beginning when you first register that loan with us, and we're going to let you know right at the beginning what that full amount is going to be. So everything's going to be included just one flat fee, and then the builder would add that fee to their contract in order to increase their purchase price and allow those fees to be financed into the loan. So you'll see here that, so the AFR utilizes a flat administration fee, which covers all your construction-related costs and all of your construction interest, except for on conventional in this case. And I'll show you that in a second. The administration fee is charged directly to the builder and retailer, not to the borrower. So that way, it does need to be included in the builder retailer's contract in their sales price of the home. It's not going to be something that's going to be disclosed on your LE as either, because it's not a fee being charged directly to the borrower. Now, we describe it as it's something being charged to the builder, but the reason why we describe it that way is because the builder is adding it to their contract. And the reason why we do this is because so that when you're going through construction and you're doing those draw fees, those inspection fees, your interest for each month, for us doing the administration for you, all the coordination, the modification, the permanent title fees, because all of those different fees are happening during construction, we raise the purchase price based on that amount so that the builder doesn't lose their profit, because that money is actually being taken out of their purchase price. So we tell them how much to raise it by, so that way we can cover all of the stuff we need without eating into what they're expecting to make at the end of the day. So what I'm going to do is actually the next page I'm going to bring up is going to give you kind of an idea. It's going to have some charts on it with some numbers for the administration fees. Before I jump to that page, and it will say it on the page as well, but I always want to give this caveat before I know if anybody's taking notes, is that this chart is based on 5 months. So a 5-month build. If the build is longer than 5 months, the fees on this next page are going to be higher. But this will at least give you kind of a general idea of what it's going to be at that base level of a 5-month build. So jumping to that next page. So here is your different types of construction administration fees. And it's broken down, those different charts are based on what particular agency or program you're looking to use in combination with the one-time close. Now that first one up there at the top is going to be your no draw. So like I was saying earlier, if you're doing a no draw, it's going to be a flat $2,500 for that. Now, like I said, the build has to be 5 months or less in that case. And the builder's not getting paid until the home's been 100% completed, and they have to be able to do that. But that would be the no draw. So that would be a reason why a manufactured dealer, let's say, why they want to do that, because they have a less fee in that case. Now we start getting into the other types of things. Now this middle chart, this is going to be the conventional one. So if you're thinking about conventional, it's going to be this middle chart. So this middle chart is if the borrower is paying the interest payments for each month that construction is going on. Because the interest payments are not being rolled into the loan, those fees are a little less than the government options because the borrower's paying them out of pocket. They're not financing them in. So you can see that it's all based on what the builder's contract price is at. So if the builder's contract price is at 400,000, if it's between 300 and 400, then the administration fee for 5 months is going to be 6,500. So that's going to cover all of your construction related costs except for the interest payments, which is being paid out of pocket by the borrower for each month that construction is going on for. For each additional 100,000, it'd be $500 from there for the 5 months. Now, there isn't really a calculation that we share with the public when it comes to what that fee would be for each month over those 5 months. That's the reason why that as part of the process flow of this program, we do require you to provide us with those numbers right at the beginning. That way our team would be the one who would do those calculations for you to determine what the fee is going to be like on your specific transaction. And then the final chart down here, the final chart down here is going to be the government option. So this is everything being rolled in. So everything being financed into that fee. So your interest payments are financed in, your draw inspections, your modifications, your title updates, your construction administration, all that stuff is going to be rolled in on your government option. So that's going to be this chart that's down here. And you can see that those fees are a lot higher because everything is being rolled in. But this is an option where if you have a borrower who's not really able to make those payments for each of those different months and you want to finance everything in, this might be a better option for them, because even though you are raising your purchase price to cover and add that administration fee in, it does allow you kind of a better way to have lower closing costs for your borrower by having that all rolled into the cost from there in those cases. So the biggest thing, the reason why I give that caveat about this example being 5 months and from there, is never provide the builder with this information prior to getting the calculations from us. Things can change on a loan-by-loan basis. It's different for each transaction. So before you have the builder add anything additional to their contract, please always get those results directly from our team first. That way you have the correct numbers. And then once that contract is updated, you can also use that updated information for your appraisal and all your other information as you continue moving that transaction moving forward. I just want to kind of skip to the thing, just give you a visual. Once again, just kind of hitting it home of what items are included in that administration fee. So you see the construction interest for each month of the build, not including any early completion or extensions. Like I said, whatever we closed on is exactly what the builder's getting. Up to five draws and all the required inspections for each of those individual draws and the any updates that have to be done from there. The actual construction underwriting that we're doing for you, and all of the closing coordination that AFR does for you in that case. Because once the loan has closed, the responsibility of our lending partners is 100% done. AFR takes over that loan 100% once the loan has been closed. So all the communication between the builder should be directed directly to our one-time close team here at AFR, and they will be the ones providing updates and communication and the draw inspections and the draws directly to the builder after your post-closing section. Once again, just stating there, that administration fee is charged to the builder by being added to the contract. It is not something that's going to appear on the borrower's disclosures as a separate fee. So just to kind of go, I have a couple other sections here, but I don't want to keep you guys too long. But just to kind of jump through some of these things, just to kind of bring it home for some of the things we've touched on already, what is the target market for our program? Like what is the best way to market this program? And what it is, this program is not for a borrower or builder that's looking to build $1 million custom home with the perfect credit and significant money down. It's that our program is not really designed for that. Our program is more for your first-time home buyers. So home buyers looking to have affordable options because there's not a big market for existing homes that would fit into what they're looking for. While we do have many different types of options under different agencies, our program is really designed for those people who are looking for something a little bit more affordable, and somebody looking to get that first time home from there. First time home buyers and homeowners who really do need low to no down payment options. And the thing too is that the program is not really a borrower loan; it's really a builder loan. And the reason for that is that the builder's protected. Now, if you were to do a traditional construction loan, so if you were to go out, let's say to a bank, and you do a traditional construction loan, in those cases, what's going to happen is that those traditional construction loans, they only close once. They close twice. I mean, they close twice. And in those cases, what's going to happen is the borrower is going to have to requalify. And if the borrower doesn't requalify once that home's done, that builder can get stuck with that home because now they don't have somebody who actually is going to provide the financing to purchase that home from that builder. Now they got the financing to build the home, but now they're stuck with that home because that borrower that was originally involved no longer qualifies for that loan. With our program, they're protected by that. Because we close and everything is set in stone 100% prior to closing, no matter what happens to the borrower, let's say unfortunately the borrower does not qualify anymore to pay for that. As long as the builder builds that home 100% to completion, they're guaranteed to get their money, no matter what happens to that borrower. So that's why we say that it is really great for builders and retailers, because it allows them to sell and build their homes with less risk and penetrate a larger segment of their particular market. So just to kind of jump from here, a couple different things. I'm actually going to go over things. Just some important things to remember when it comes to the program. Like I said earlier, do not have your builder or retailer add that construction administration fee to the price until you get the confirmation from our one-time close team to go ahead and have the correct numbers from there. If any fees or costs change throughout the process from the beginning all the way through, please let us know immediately. That way we can go in there and update that. One minor change can affect anything. That's why we do need to make sure that the builder and the borrower understand that once fees are set, those are the fees that are going to be provided after we close. They can't be changing their mind back and forth in those cases, because let's say the builder tells us at closing he needs 6 months to build. And then we're 3 months into the build and he says, oh, I need an extra 3 months. Unfortunately, the way our program is designed, we wouldn't be able to do that. For those additional 3 months, that money is going to be coming out of the builder's profit. So that's why they need to really be sure up front that they know exactly how long it's going to take for them, how much it's going to cost, and have all those different things. Now, if they want to build in a little extra time, which they think might be more than that, they could do that. But remember, for government, the max would be 12 months, and for conventional, the max will be 10 months in those cases. For those of you who would be working directly with AFR, we do have a section in our system where you would request any changes in those cases. That way our team could go ahead and update that information. So just to kind of I want to jump to different things, is that what's going to happen with closing. So at closing, no matter which option you're using, the land seller is going to be paid. Or the mortgagee, like whoever, if that land is owned in a lien, or whether somebody's purchasing that land, whoever is the land seller will be paid at closing. So the only person who's not paid directly at closing would be the builder. Like it says right here, there's no initial draw to the builder or retailer at closing. So the land seller would get their money, and the commission for the realtor and the commission for our lending partners will be paid based on the closing date in those cases. Once the loan has closed, the builder can go ahead and start doing construction as soon as possible. They can start immediately. And then what's going to happen is that shortly after closing, usually a couple days or so, maybe a week, the boarding process will begin. Somebody from our AFR construction team will reach out directly to that builder or retailer and start the process of how to request draws. Let them know, okay, here's where you go to request the draw. Here's what's going to happen when you request the draw. Here's how much money you're going to get, different things like that, and the process from there. So then that way they're having that communication throughout the entire kind of post-closing stages on the communication of when draws can be requested, how they work, and so forth. Like I said, AFR will work directly with that builder retailer for all draw requests and project inspections. At this point, broker, no need to be involved unless, of course, from a customer service standpoint. If you want to stay involved, just kind of check up on what things are going on. We're more than happy to provide an update from those cases. Every time the builder or retailer requests a draw, AFR will immediately order an inspection to confirm that that work was completed. Once we confirm that that work is completed, we'll be able to forward the draw instructions so to make sure that we'll have all that information corrected and make sure the builder can get those funds for the work they've done up to that point. So just to kind of jump from there, I want to jump and kind of wrap up here. So here's some do's and don'ts. Now, these are some big pieces, and a lot of times we see certain things and little stumbling blocks that people come across as we offer this program to a lot of different people across the country. And we've kind of taken a lot of frequently asked questions and a lot of things that we've seen and made this little bit of a do and don't list so that you can keep in mind and have a good, nice head start of knowing these things and keeping them in mind when it comes to offering this particular program. And the biggest don't we have right here in bold with a little sign there too. Do not let the borrower, builder, retailer, or anyone start any construction or site improvements before we close. As soon as any work has been done to the property, it automatically makes it so we cannot proceed. So even if they bulldoze the land, like they haven't put up any structures or anything, if they even touch the dirt, it could automatically render the product completely ineligible. We wouldn't be able to proceed moving forward, no matter what stage we are in that loan. So that's the biggest thing, to make sure you let them know, don't touch anything until the loan has actually fully been closed. Do always use the loan structuring tool in our system to make sure you have your full contract numbers before the builder adds them in there. Make sure your numbers are correct. Don't allow the borrowers to be the builder, contractor, or don't allow the borrower to hire their own subcontractors for the construction, as that would be ineligible as well. Always set your proper expectations regarding the turn times on this program. This program does take a lot longer than a normal purchase transaction. Always under promise and over deliver. Traditionally, for this program, a realistic turn time is 60 days. Now, in today's market, with a lot of kind of other crazy things going on, it may take longer than that. But at normal, it's about a 60-day as a realistic expectation, and that's kind of a best case scenario with everything firing on all cylinders. So always be setting those proper expectations in the beginning, and that way everybody who's involved with that transaction kind of understands what's happening as we continue moving forward. Don't allow any family members to be part of the transaction, meaning on the builder side. So they can't be the builder or the retailer. Everything has to be arm's length. And do consider something. We've seen this be successful, depending on different companies and different people we've worked with. Do consider having a dedicated person who works on just this particular program. And we've seen that be a very, very successful way of doing business with that, because the program is very complex and has a lot of moving parts. So if you have one person who's focusing on just that program and figuring out all the pieces and exactly how it works, it's great, because then that way that person becomes the expert, and you not only have AFR as a service and as a place to go to ask questions, but you also have somebody internally on your side who can go, oh yeah, I know what that is. So that's a great way, and something that we've seen be very successful in the past. Don't let the borrower think that they can get any funds from a one-time close. The borrower does not receive any funds, reimbursements, or cash back from a one-time close transaction. If you do have any questions, the last two on the do's kind of are together. If you do have any questions, always feel free to reach out to us. We're more than happy to answer any questions, whether it be kind of scenario stuff, whether it be on a transaction that's going on from there, or just, is this something that'd be allowed for this program? If you have any questions, always feel free to reach out to us. We're an open book when it comes to that. We love getting questions. No question is a stupid question, because we want to make sure that you're there, not only for your customers, but also for everybody out there who's working on that transaction. We don't want there to be any confusion. We don't want there to be misinformation. We want to make sure that everybody's 100% clear on what's allowed and what's not allowed for the program. And then the last thing, no subordinate financing allowed. The last kind of slide here just goes into some visuals of things that would not be allowed on the program prior to construction, just kind of hammering home a little bit more specifically on what would consider the project ineligible if any of these particular things had happened prior to that loan closing. Of course, once the loan closes, then you're perfectly fine to start all of these different things. But if the property looks like any of these pictures, unfortunately, it's something that we wouldn't be able to do for our particular program. So at the end of that, I do kind of put up here on the screen, we do have a team here at American Financial Resources that is more than happy to answer any questions. Of course, any other partnerships that you have on your end, you're more than happy to kind of share those questions between each other, and you can send them over to us, and we'll be happy to assist you from there. So we do have this team. This team goes to both myself and my dedicated team that I work with here in our headquarters here in New Jersey. So whether you get myself or one of my dedicated team members, we're always happy to answer any questions you may have about your partnership with AFR, and of course with anything that has to do with the programs that we offer here at American Financial Resources. So once again, I thank you so much for joining today. Thank you, Omar, for inviting me and allowing us to present this information. If anybody does have any additional questions, feel free to shoot them out now. I'm more than happy to answer those. If not, we're always here to assist you if you have any questions moving forward. Thank you again.
Jonathan, thank you for all that good information. We do have one question. It says, can you do a longer escrow than 120 days? And I think what it's getting to is, I mean, I understand this is across the nation you're doing these loans, but like here, like in Los Angeles County, in Orange County, let's say Southern California, it just takes longer to get approvals. I mean, it's going to take maybe up to a year. So I know, maybe someone can get a head start, but I mean, that 120, 180 day escrow, is there a way to do like a 5-month escrow, a 6-month escrow, where it's open that long while in the process of doing these plans and permits? Because then it's in contract already. The land's in contract. You have a purchase price, but you're getting at least the permits done in the process. So when you're within 60 days or 50 days, you can say, okay, look, we're within 60 days of getting approved. Let's move forward on closing this thing. We're trying to customize it to some extent on how things get approved over here, because a 10-month build is just not going to be enough time to get permits and build the property.
Yeah, and unfortunately at this time we don't have an option like that. It is, just in full honesty, it is something that we've run into in the past when it comes to California and this particular program. It's just that at this particular time we don't have any options for that. Like right now, like everything would need to be like kind of set in stone. If it is going to take a year to kind of even get the ball rolling in that case, we would require those things to be done prior to even that loan coming to us, because once the loan closes, for our program at least, we would require construction to start immediately once we close. There wouldn't be any options for the programs that we offer to push it off any further than that.
Yeah, but if we start to say we tie up a property in our contract, let's say a land contract, because let's say they have enough money for the 10% down, let's say conventional, they tie up the property for the land contract, they write something in there, say we're going to go through the permit process. Let's say usually land doesn't move that fast. So they say, okay, we'll buy it in 6 months to 10 months while we go through the approval process. So basically the buyer would have to spend money, right? Apply for the planning department to get it approved. Let's say it gets approved in 10 months. Basically it'd be an escrow, but let's say on month 8, we contact you and say, hey, we're a couple months of being approved. Let's start this thing. See what I'm saying? So then we're closing and we're getting the approval process and we've been escrow for like 6 months, but we're going to start the loan right very near to the approval process, so that when you guys in 60 to 120 days and you approve the loan, we've already had the permit approval. Does that make sense? I'm just trying to guide the audience of the realtors on here to how to possibly structure a land purchase in a situation like that.
So I mean, for the way that our program works is that, so the thing that you would probably have to do in that case is that if the purchaser, if the buyer wants to purchase that land prior to our transaction, whether they get a separate loan or they purchase that with cash or whatever way in that case, they could do that. For our program, we wouldn't be able to have like a separate start for the land and then roll in the construction later. Like they would be done at the same time for ours. So if it is going to take that time, then the best advice, at least for if you want to use our particular program, the best way to do it would be to have the buyer, have that purchaser buy the land prior to our transaction, whether they get a separate loan or they buy it outright with cash or however in that case. And then once they're ready once they get the permits and things, then they're ready to get ready for the construction part, then they come to us for the construction piece.
Yeah, that makes sense. And then another thing in regards to, I know we're talking about land, but this also applies to tear downs or additions too, as well, right? Or no?
So this would, so it wouldn't be applied to additions. So additions wouldn't be part of this particular program. This program would be for from dirt up construction only. So you can tear down a home. So like if they have an existing home on the land and they want to tear it down, as long as the builder includes the cost of that tear down into their contract, you could do that. It's just the biggest thing, like I stated earlier, you wouldn't be able to have more than one structure on that piece of land.
Yeah, that makes sense. Okay. Well, I don't see any other questions, and I just really once again thank you for explaining that to us. Hopefully, we get some stuff going. I think we just got to figure out how to structure. I mean, there's some people out there that own land already, and figure out the permit process and all that stuff. But either way, it's some good information, and just wanted to thank you and everyone else that's on here.
Sure. No, it's our pleasure. If there's anything you ever need in the future, always feel free to reach out. We're happy to help.
Okay, so sounds good. Everyone be safe out there. Jonathan, thank you. And you guys have a blessed day.
No problem. You too.